All right, everybody, welcome back to the Matty Moolah Show. So today, I don't want to bash on Uncle Warren or anything like that, but I've seen a lot of people on, say, X and Twitter or whatever you call it these days, talk about how Berkshire is so cheap and how everybody should be running to buy it. And it's got a price to earnings of like 10 or something stupid. And I'm just letting you know, right? This is part of the things that Chris and I talked about the other night with our top 5 investment mistakes is do due diligence, read through the earnings reports, understand where those numbers are really coming from, because if you utilize that and just assume that you annualize that on a 4-quarter basis, you're going to be like, this thing's making $100 billion a year. So, it being a what $780 billion company, it's got a price to earnings of 7 or 8. And there's no reason why you shouldn't be buying this company. Keeping in mind that a lot of the earnings that are going to be coming from this are mark to market and has a lot to do with the capital appreciation of the equity portfolio. And if you don't understand what that means, stick around. We'll talk through it, right? So a lot of you guys don't understand that Berkshire is a huge conglomerate of multitude of different businesses that generate a crap ton of cash. And with that crap ton of cash, Warren either buys companies outright and has them operate as standalone companies as a subsidiary within Berkshire Hathaway itself, or he buys minority controlling, non-controlling interests in companies like Apple and American Express and a bunch of other companies like Oxy that he thinks are really good companies that he doesn't necessarily want to own 100% of, or he can't because of the cost. But then that has a mark-to-market accounting piece with respect to the portfolio as well. So here we are sitting at $534,000 per share, or about $780 billion in market cap. So people are probably saying, oh my God, it's got a price to earnings of 9. Let's run and buy as much as we can of Berkshire Hathaway because it's so cheap. Now, just immediately doing some due diligence on your own in the provision of property, casualty insurance, reinsurance, utilities, energy, freight, rail, all this. So you're probably saying like, I didn't realize that Warren Buffett invested in those sorts of stocks. Well, he doesn't, right? He bought a lot of them outright. So when you look, Geico, Berkshire Hathaway Reinsurance Company, Berkshire Hathaway Primary Group, Burlington Northern Santa Fe, which is a huge railroad company, Berkshire Hathaway Energy, which is a huge renewables company, McLean Company, all these sorts of companies, which we'll touch a little bit on in the underlying, say, umbrella of Berkshire Hathaway, contribute to the operating income. Now, immediately what you might be looking at specifically is this news release, and immediately what you're seeing, $36 billion in the second quarter of income. Multiply that up by 4. This thing's making $130 billion a year. And then you sit there and you're like, well, shit, last year they lost $43 billion. It's like, what? This doesn't make a lot of sense, right? But if you actually dig into it just even a little bit, you'll understand from investments and derivative gains, $26 billion in 2Q of 2023 versus a $53 billion loss in 2022. Now let's take just a brief step back. What happened in 2022 from January to June, just over a year ago? The market tanked, 20, 30% in a very short amount of time, basically from January to June. So what does that mean? Well, when you have a large stock portfolio like Warren Buffett, which we'll get to in a little bit more detail, but let's just say it's on the order of $250 to $300 billion, and it declines by, 20 to 30% within the first half of the year. Let's just take 10% of $300 billion, and boom, from April 1st to June 30th, the value of those properties or equity positions dropped by $53 billion. That's what it's saying. What happened from April to June 30th of this year? Well, let's just take a quick look. What happened? On the S&P 500. Now, I know it's not verbatim, but let's just take a quick look. So here we are, April. We were at 403. This is March 30th, March 31st. We were at 410. So 4,100 on the S&P. And by the time we got to June, early July, we were at 443. So that's a 10% increase. It's pretty good. So let's think about that. 10% increase, $250 to $300 billion portfolio. Huh? Magically in 2Q, we were up 25 billion, 26 billion in investment derivatives or derivatives. And this is what I'm talking about. Unfortunately, when you're a public company, Amazon has to do this, Palantir has to do this. If you have any non-controlling equity positions in the portfolio, you have to report that on your balance sheet. So if when Rivian IPO'd last year or 2 years ago, and it went to like $100 billion valuation, Amazon had to record all that net income on a mark-to-market basis. And also was a drag throughout 2022 when the stock continued to depreciate in value. Got it. So hopefully that helps a little bit. But understandably, this 9.4 that we had in 2Q of 2022 and this 10 billion in 2Q of 2023 is the underlying impact of the wholly owned businesses. Now, what does that specifically mean? Here are all the wholly owned businesses, right? So you have Acme Brick Corp, Berkshire Hathaway Energy, Burlington Northern Santa Fe, Duracell, Fruit of the Loom, Hellsberg Diamonds, a bunch of stuff. Lubrizol Corp. So these are wholly owned businesses by Berkshire Hathaway. Pilot, you go travel anywhere across the United States, you might see Pilot fuel stations. You might see Burlington Northern Santa Fe, the big orange giants traveling across the mountainside in Nebraska all the way to the West Coast. Big purchase back in 2012, 2013 for Warren Buffett. And then Berkshire Hathaway Energy, those of you guys that aren't familiar, huge renewables company here and continuing to grow. And they just had a huge investment as well in Cove Point, LNG. I think they now own 75% of it. So let me just do a quick recap then. So let's just say you don't hold a lot of value, and I know on a long timeline basis, the equity position means a lot, right? So I'm not going to say that it doesn't. But when you're doing like specifically what is the underlying operating income of the controlled businesses, in this case, it's about $9 to $10 billion on the first half of the year, $17 billion in 2022, up to $18 billion in 2023. Great performing businesses. These alone are worth hundreds of billions of dollars, right? So I don't want to devalue that whatsoever. But I think what a lot of people are valuing is the $71 billion year to date of earnings, when in reality, a large portion of this is just equity positions gaining in value. And I'm like I said, as long as you understand that, that's fine. But if you were to start saying, well, it's a $780 billion company, just through the first half of this year, it's up $71 billion in net income, you're going to be sitting there saying the price to earnings is too cheap to pass up. Let me whole port Berkshire Hathaway Energy or Berkshire Hathaway. And in reality, you probably wouldn't do that bad. But I'm just trying to help you guys understand a little bit about how to read a balance sheet, how to read a cash flow statement, understand what the heck you're investing in, right? So let's go now into the actual segment data for the consolidated financial statements of Berkshire in 2Q. You go into it a little bit and it starts showing you a little bit into what each individual company had in terms of revenues. You can see $92 billion worth of revenues coming from the operated businesses. And then you start to understand, you roll it into the earnings piece, right? So what did the operated businesses make? They made about $11 billion in EBITDA, I assume, in this particular case. I don't really see it here. Then you had $33 billion worth of equity differences compared to $66 billion worth of losses of equity in 2Q of last year, right? But keep in mind, you still have this underlying operated businesses. Geico, $500 million in the quarter. BNSF, $1.6 billion in the quarter in terms of earnings. Berkshire Hathaway Energy, $600 million in the quarter for earnings, right? Huge businesses on their own that are contributing to Berkshire Hathaway's bottom line. And so if you were to truly understand, and there's another piece of how much cash does the company have. I mean, this is why it's difficult to evaluate some of these companies, right? But you can start to understand why there's a reason why this company on its own is worth $780 billion. And I'll get to that point in just a second on how you could potentially evaluate the company a little bit easier or a different way other than just using this weird price to earnings, utilizing inflated mark to market accounting sort of numbers. So I think there was like another piece in here as well that I wanted to share. Oh, I think I separated it out here. So it's pretty cool how they also share a little bit about in the actual investments in equity securities that they own from year end of 22 to the first half of 23. They kind of display what they were basically worth. So looking at where we were last year, the cost basis of what the equity positions were across banking, consumer products, commercial, industrial, everything was $131 billion. So at some point, Warren invested $131 billion. And it's actually pretty cool because you can kind of see a lot of it is invested, and you can kind of see the actual conglomerate of investments down here where the majority of the value sort of lies of how much money is in each. Then you can see the unrealized gains. So this is like Apple, I assume, in the consumer products. You can see how the commercial and industrial businesses are not doing 100% well. And then the banks and insurance and finance are doing rather well. And then you can understand, these are the gains, right? So it's not how the portfolio difference actually. So anything positive here is a net gain. So you can see you end up with a fair value of $308 billion at the end of 2022. Now go into where we were 6 months later. You could see $70-odd billion of increase in net unrealized gains. So we went from $177 billion to $237 billion. So that's an increase of $70 billion, or maybe I'm wrong, $60 billion, something around there. I'm not good with math. But you can also see the total value of this going from $308 billion to $353 billion. And so you have to account for that on the net income statement. And so that's where a lot of these volumes are really coming through. But it's pretty cool to see 78% of the fair value in 5 companies: American Express, $26 billion, Apple, $177 billion, which was up from $119 billion at the end of the year. Crazy. Bank of America, $30 billion, Coca-Cola, $24 billion, and Chevron, $19 billion. So you can see sold out of a little bit of Chevron, sold out of a little bit of Coca-Cola, or Coca-Cola went down. American Express went up. Apple went up year over year. And then Bank of America, he either sold out of some of that position or it went down. My anticipation is that the value of it went up and he sold out of a portion of it. So that is kind of understanding a little bit about what this company is invested in and understanding a little bit. So let's just take this to heart, right? So let's do some mathematics, because why else are we on the channel? So there's another piece in here as well. It might be very early on talking about it. Cash, short term. There's a piece in here, short-term investments, yada, 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 about how much cash. Okay, I got it now. So going back into the mathematics, so let's just take a quick look here. So we know the fair value of the company based off the stock price today is $780 billion. Let's subtract out the 353 of the equity position. You're left with $427 billion. And that's associated with, like, if you were to liquidate all the equity positions today, let's not get into the massive taxes associated with unrealized gains and everything like that. Let's just say, like for like, you're able to wipe it all out. You're left with a value of $427 billion. But then you also have to take into account all the cash that's also within the company. So you're obviously going to get a dollar for dollar associated with that. So let's just remove that, right? So it's $140 billion, let's just say. minus 140. So you're now left with $287 billion worth of other companies' valuations, right? So you've removed the stock of Apple and all those things. You remove the cash. Now you have $287 billion. So you know that this makes a roughly 30 odd billion dollars a year in operating income. So what you're really paying for in this particular case, everything else you can kind of break down. Cash, you're getting a 1-for-1, hopefully. The equity positions, you're going to be able to wipe out 1-for-1. Right now, what you're kind of looking at is $287 billion remaining after removing all those things and paying for that with respect to the underlying businesses, the Berkshire Hathaway Energies, the Burlington Northern Santa Fe's, the Benjamin Moore paint companies, the See's Candies, all these things that are wholly owned subsidiaries of Berkshire Hathaway. And really, that's what you're kind of hoping. The part of Kraft Heinz, all these things, right? So it's pretty interesting, right? And like I said at the beginning, I didn't want to display that this is a bad investment by any means, right? But I see some people just not necessarily fully understanding how to appropriately evaluate the company. And I did a horrible job running through it in a very quick manner. But I hope that at least you kind of understand just the minor due diligence. You can figure out some of this stuff just by jumping in to the actual earnings report, the earnings statements, and the cash flow statements, stuff like that. You can get into this very, very quickly. And you can learn a lot about what's BS, what's funny money, what is true underlying cash coming into the company. Because we could very much, let's just say, for example, go down 10, 15% in the stock market, and Berkshire Hathaway's earnings for the third quarter are going to be abysmal because here we have another month to go. And if you drop 10, 15% from here, that's going to end up having to be showing up on the net income statement of Berkshire Hathaway because you have $350 billion at the end of 2Q of equity positions. So you're going to, next thing you know, have a net income of negative 30 billion or 40 billion. Are you going to say Berkshire is no longer investable because it has a PE that's negative? And that's kind of the point that I wanted to lay out. And a lot of times people just lay into the price to earnings and they hold it to truth. And you can to an extent, but you have to make sure that there's nothing fishy going on with what's going on at the bottom line. And so I just wanted to take this opportunity to share that with you guys. Hopefully you learned a little bit. And let me know what you think in the comment section down below. I hope this was useful for you guys. I'll see you guys in the next video. Cheers.